Well, good morning, everyone, and welcome to our Markets Insight webinar on the 19th of June. My name is James Sheehan. I look after the National Interest Rates, FX and Commodities Risk Advisory business here at NAB. There has been some significant market volatility in recent months, mostly headline-driven, with the prime example being Liberation Day in the US when Trump announced the beginning of a tariff program that is still unfolding. The next RBA meeting is 7th of July, and the prospect of cutting rates has been significantly heightened by the hot conflict in the Middle East, which also has a lot to play out. As Tapas, our economist, will highlight today, the market is pricing in close to an 80% chance of a rate cut in July, and NAB is forecasting 3 cuts by the end of the calendar year, taking the cash rate to 3.1%. During this turmoil, the AUD against the USD has rallied from the mid-61s in January to be now holding at 65. Today we will hear from NAB's Chief Market Economist, Tapas Strickland. Having a long career in economics, including 6 years at the RBA, Tapas now plays a key role in forming NAB's large customer base on Australian and global economic trends. One place you can hear Tapas regularly is on the Morning Call podcast. We'll show you more later how you can subscribe to this valuable podcast if you don't already. Good morning, Tapas.
Good morning, James.
We're also joined by Shane Ditcham. Shane is a state business banking executive for Metro New South Wales. Shane has been with NAB Business Banking since 2010 in a couple of stints, always facing into the ever-important Sydney SME business banking sector. Shane's team of business bankers are located where our customers are, in locations such as Hornsby, Marrickville, Hurstville, Chatswood, Penrith and everywhere in between. Good morning, Shane.
Thanks, James. Good morning, and sort of welcome to all our business owners and operators joining us today and our NAB business bankers. Very much looking forward to Tapas helping us or sharing some of your insights. Tapas, I can say from our customers what bankers tell me, my own conversations with customers, trying to understand and navigate through the uncertainty at the moment. Today will be very helpful and I'm looking forward to it.
Terrific. Tapas will give us an update on market conditions and help us to interpret this RBA easing cycle and what we might expect for the rest of the year in interest rates and the AUD. As always, we encourage people to put questions into the chat live. And we'll endeavour to get to those as we go through the webinar rather than just have them at the end. So we'll endeavour to get to questions live. So please ask them as we're going along. The update is designed to be as short, as sharp as possible and get in and out inside 30, 35 minutes. If we don't get to your questions, we will park them and someone will come back to you individually. All right, over to you, Tapas.
Thank you, James. And good morning, everyone. In today's presentation, I want to give you a bit of a feel for where we're at NAB seeing the domestic economy at the moment, what are the headwinds that are going on and what we're hearing from customers as well. Give you a bit of a flavour for where we're seeing the international economy, global headwinds. As James was saying, there's a lot of headlines going on, but exactly what is the Trump administration trying to achieve and how does that eventually impact in terms of Australian businesses? I think it's going to be very, very key for the outlook. For our near-term forecast for the Australian economy, we're still in that soft landing camp, still seeing the unemployment rate relatively low, only seeing it gradually lifting up to about 4.3% at its peak. If you remember, prior to the pandemic, the unemployment rate was about 5.2%. So still a tighter labour market now than we were prior to the pandemic. For the cash rate, as James was saying, we think the cash rate will be cut in July, and we look for a few more rate cuts, bring the cash rate down to about 3.1%, where we classify that to be broadly neutral setting. And the chart on the left-hand side here just shows you our rates forecast relative to where the market is pricing. And at the moment, the market is pretty much in agreement in terms of where we're thinking the RBA cash rate is going to be, if not just a little bit below where our profile is at the moment. Now, it's been moving about a little bit over the past couple of months as markets become a bit more attuned to some of the softer reads that we're seeing across the domestic economy, particularly in regards to retail trade, but also in regards to the wider GDP figures as well. At the same time, inflation has come back down closer towards target, but there are still some underlying measures of cost pressures that still suggest we should be relatively cautious about rate cuts beyond 3.1%. And I think it's really going to take either a bigger shock offshore or a greater domestic slowdown to really get the RBA to cut rates below what we think are broadly neutral levels. Now, if you've been on these webinars before, you would have heard me expound at length about neutral rates. At the moment, the RBA's suite of models suggest that neutral rate is averaging around 2.7%. And if you were to read the RBA minutes recently, that is more suggestive that the RBA board thinks that neutral rate is around 3.5%. The end message from that really, though, is in the absence of a bigger offshore shock, it's harder to see rates go too much below 3.11%. And so that's what we've been advising our clients for the past couple of years, is we're not going back to that low rate world in the absence of a bigger shock in terms of the global economy or in terms of the domestic economy.
I think it's a really good point to just pause. It's a huge point that you make about the shallowness of the cycle. So if we talk about easing cycles, which are really as regular as hiking cycles, and what we look at over the next 6 months of this year, whilst we do see cuts, we see that being quite shallow. I think that's a really important point. And Shane, a lot of the borrowers that you talk to will be looking for lower rates, but it's really important for them to understand that we don't see them going to those below 3 levels.
It comes up in the conversations a lot. I'm glad that we're covering it today as well. And probably in the frame of the costs in business at the moment. We're seeing rising costs from conversations coming from materials, capital imports that we talked about, Tavis, coupled with challenges finding skilled workers generally, in many industries. So it adds to cost pressures, focusing on interest rates as a key input.
And going back to James's point, you have seen quite substantial rate cut cycles in the past, but those rate cut cycles were in response to a big offshore shock. So you think of the pandemic, you think of the global financial crisis. What we're seeing here is rates moving back to a less restrictive setting, getting back to a more neutral setting, and the unemployment rate still remaining much lower than where it was prior to the pandemic. And I think part of the reason, and Shane just brought it up then in terms of costs for firms, part of the reason why the RBA probably doesn't want to cut rates too far is if they get a bigger pickup in the domestic economy than they are thinking, then that leaves plenty of scope open for firms to try and pass on the high cost that they're seeing across their own businesses. The chart on the left-hand side there is from the NAB monthly business survey, and each month we survey about 400 businesses, ask them a whole heap of questions. One of them is, what are your cost pressures growing at? All of them are still saying their labour cost growth is still growing at relatively robust rates. Their purchase cost growth is growing at relatively robust rates, but their ability to charge those prices onto their final client, or what we term final prices, is much less than it had been previously. And so with pretty robust input cost growth still, you're starting to see margin squeeze, profits being squeezed. In our survey, at least, which asks the question, has your profitability increased over the past month? Our respondents are saying it's actually decreased over the past month. The respondents are saying profit margins have been also squeezed. But at the same time, firms are still running relatively high rates of capacity utilisation. Now, that's what our survey is saying. We also like to marry up the data to other sources of data just to see whether that's providing a good guide in terms of what's going on. And when you look at the ASX 200, the listed corporate space, you look at operating margins there, and operating margin is effectively EBIT divided by revenue. Operating margins have been declining over the past year in the listed space, whether it's materials, financials, consumer discretionary, or consumer staples. So there is a profit squeeze that is going on at the moment. So I think it was right that the RBA did cut rates in February, right that they cut it again in May. We are expecting a few more cuts. But at this stage, it doesn't look like we're in for a very deep rate cutting cycle because of those very elevated input costs for firms. It's also important to think about what's actually been driving this moderation in inflation. And some of you may have seen me present this chart before and highlight the large role that new dwelling construction costs and rents have on Australia's CPI basket. New dwelling construction costs have about an 8% weight in Australia's CPI basket, and rents have about a 6% weight. They also correlate quite closely to other cyclical sensitive components of prices. And what we have noticed is a lot of the moderation in inflation from the peak of the pandemic has actually occurred because new dwelling construction price growth has eased. And some of you who are in building construction would say, well, no, my input cost for new dwelling construction hasn't actually changed. It's actually still rising. But what the ABS picked up in the last couple of quarters is developers actually discounting some of their stock in order to sell. The question really is with the housing market still very, very tight, with vacancy rates low, and with a vast dwelling undersupply, is that likely to be sustainable, particularly in the environment of the RBA cutting interest rates and increasing potential borrowing capacity? So I think there are some reasons to think core inflation, yes, it's around the midpoint of the RBA inflation target, but there's still some risks out there that perhaps inflation settles a little bit above that midpoint of that target if you don't get sustained improvement on inflation in other components of the basket, just given a lot of the moderation in inflation that we have seen is really on the housing components of inflation. Uh, Across our surveys and across the customers that I talk to, and I talk to a lot of customers right up and down Australia. I was in Darwin last week. A lot of them are reporting the consumer is still relatively soft and hasn't really responded to the interest rate cuts that we saw in February. And I think part of the reason is the framing of that February interest rate cut. I remember doing a few webinars on it. Was it was a politically motivated interest rate cut. A lot of people thought the RBA was going to be one and done in February, and perhaps that didn't really lend itself to a cycle of interest rate cuts. And perhaps it's only now that consumers are becoming more aware that there could be a couple more rate cuts on the horizon. But when you look at the actual spending data, break it down by two different components. So one of them I like to look at is the regional split. The weakness in the economy, at least at a regional level, is really coming from Greater Melbourne. So when you look on our card data, consumer spending per card holder, it's a lot slower in Greater Melbourne than it is in Greater Sydney. And so that is definitely one soft spot in the domestic economy, is what is going on in Victoria.
And that's a good point to pause there as well. We've got a lot of our customers from Melbourne on this webinar today. We talked briefly before the webinar about some of the depressed conditions in Melbourne. What's your take on that at the moment?
Yeah, it's a very good question, and I have the privilege of sitting on some of NAB's risk committees as well, and so that's definitely a topic for us internally as well. And three reasons that I generally give are the first one is energy prices have been high for quite some time. A lot of uncertainty in terms of gas prices. That's putting a lot of pressure on manufacturing, particularly food manufacturing. And we know Victoria is Australia's largest state in terms of manufacturing. So that's putting a lot of pressure on the manufacturing sector. The second one is government policy uncertainty, particularly in regards to taxes, is definitely impacting on sentiment there. And the third one is, unlike the rest of Australia, which is seeing quite substantial house price growth, Melbourne house prices haven't really grown by that much over the past couple of years. So while in Sydney, in Brisbane, Perth, Adelaide, we're seeing quite substantial house price increases, I haven't seen those in Melbourne. Now, we're just starting to see it lift a little bit, but for those people in Sydney, it may be of interest to note that over the past couple of years, dwelling price growth has been to such an extent that a dwelling in Brisbane is now more expensive than a dwelling in Melbourne. And a unit in Adelaide is more expensive than a unit in Melbourne. So a big change in relative house price dynamic, but also that's creating a lot of affordability divergence, and I think that's what's driving some of the recovery you're starting to see in Melbourne. As people who are starting to get priced out of some of those other capital cities now look towards Melbourne as being relatively more affordable to them. The other interesting aspect of it is when you split it up by demographic split or by age splits, what you're seeing is relatively weak spending growth for those people who are under 25. And I mentioned how the housing components of CPI are quite important. One of the big increases in CPI drivers was rental inflation the past couple of years. And under 25s tend to be more in the rental cohort. So they've been really squeezed by what's going on in the rental market. And then the other soft spot in the economy in terms of age spending profiles is that 45 to 54 year age bracket. And they tend to be more mortgage holders. And so it looks like they've been squeezed in terms of the potential ability to spend outside of servicing their mortgage. So they're probably the two soft spots. But if you look forward, if you think there's going to be a couple more interest rate cuts as we do, down to 3.1%, then that should give a bit more discretionary cash flow to those people who are 45 to 54 years. And that's the reason why we still are in the soft landing camp. We still expect growth to pick up, but it's just taking a little bit longer to pick up than we had expected previously. The NAB Business Survey also gives us some feel for where different industries are right across Australia. I mentioned how Victorian manufacturing is relatively soft, but so is retail trade as well. And retail trade is not only being impacted by the relatively soft consumer, it's also being impacted the most by a lot of the disruption that's going on in the online space as well. Just to give you some indication for some of the potential disruption that's going on in that space, and also the anecdotes of the soft consumer, looking at the most recent profit reporting season from the major listed retailers, they estimated they've actually lost market share to online players such as Amazon because consumers were looking for more attractive price points for a lot of grocery items. And so I think that's just an interesting aspect of it. The cost of living squeeze is also accelerating some of those big structural changes that had been in train for quite some time. Shane, you've been talking to clients recently. What are you picking up?
Yeah, you can say the retail trade. So that weakness that came out in the monthly business survey that you referred to as well has been reflected in some of our conversations where The way it's talked about is confidence in consumers and their confidence to spend, and actually seeing that weaken, and also a bit uncertainty about it as well. So yeah, it's reflected actually what you're sharing there.
And I wonder if some of that is the international headlines that we've been seeing from the Trump administration, whether that's impacting business sentiment. Are you picking that up in?
Well, in our business conversations, and I did talk to a lot about bankers over the course of the last couple of weeks for preparation for today, it was actually top. The number one thing that comes in conversations is that uncertainty about what is happening in the world. We've seen what's happened over the weekend and the course of this week, playing into that. And it does cause uncertainties if you're a business owner thinking about, well, what's the impact of that? You know, whether it's tariffs, how it flows into the foreign exchange rate, and then when it comes to consumer spending, how confident do we all feel about spending? I guess we're seeing that as well. And I think your comment there of that insight, as consumers, we're making some decisions about where we spend and at what price point. There's a flow on from there.
Yeah. Just going back to interest rates, we have a really interesting live question about the RBAs. If the RBA is going to cut rates, should I wait until they finish cutting to fix my interest rates? It's actually a question that we get a lot. Realistically, by the time the RBA has finished cutting rates, the fixed interest rates have already reacted. So typically what we want to see is that opportunity is now. It's live. Ahead of the RBA expecting to cut next month, potentially expected to cut twice more this year, the opportunity is now. The market starts to price that in right now. You would agree with that, Taz?
Yeah, I would. And so our forecast, and it's just a forecast, so we think terminal cash rate will be 3.1%. If you look at market pricing, they've got a terminal rate of around 2.9%. So there is a bit of gap between where we're seeing things and where the market is. The market is a little bit lower than where we are.
Also a question on this slide 7, which is a good one. What is the NAB business survey conditions by industry graph on slide 7 measuring? E.g., what does 1.55 in construction mean?
It's a really good question. It's a net balance score. So if it's below 0, then conditions are contracting, and if it's above 0, conditions are expanding. And generally in the NAB business survey, as you expect, GDP growth has been positive for Australia for a very, very long time. The NAB business survey usually averages +6 in terms of net balance. And so effectively, if you see scores below 6, then things are relatively soft. If you see scores below 0, then that's firms saying, well, actually conditions are weakening. So that's what firms are saying right now. So another way to tackle this kind of viewpoint is to see, well, what is the equity market saying? Equity markets are supposed to be more forward-looking. And there you've actually seen a bit of a rally back against the April lows there, and some optimism creeping in, especially in terms of real estate. The whole data warehouse rollout, AI, is creating a lot of optimism in the real estate sector. Office property, particularly for prime, a lot more certainty, a lot of the valuation write-downs have been done there. A lot of offshore interest coming through, particularly from Japan. So I think you're seeing the share market pick up those kind of anecdotes out there as well. Now, just going back to an earlier point, Shane, in terms of what businesses, what you're picking out from businesses in terms of the offshore headwinds, I thought I would give you a good breakdown in terms of what is the method of the US, or what are they actually trying to achieve. A lot of the headlines that we see is all about the negotiating, but exactly what is the US administration trying to achieve, and how could that potentially impact on Australian businesses? So the way I like to describe this is in 3 observations. And the first observation is the Trump administration wants its allies to pay their own fair share of defence. And I think most people would see that as a pretty reasonable expectation. At the moment, the US underwrites the Western world's security, and it spends about 3.5% of its GDP on defence. Australia at the moment spends about 2% of GDP on defence. So quite a big gap there. And the US Defence Secretary has been saying that Australia needs to lift up its defence spending to closer to 3.5% of GDP. And indeed, the US wants its allies to lift up their defence spending to between 3.5% to 5% of GDP. Now, the reason why this is a problem is China overtook the US as the world's largest economy in 2016. And the US's share in the global economy is actually falling. So it's more costly for the US to actually supply that security guarantee to the rest of the world. So I think it's an unfair, reasonable expectation that the US taxpayer should be taking up this bill. Now, obviously, there's a lot of negotiation here, and all we really see is a negotiation in the headlines. But I think the quote down the bottom there on the left-hand side by the Polish PM, I think, is quite pertinent. And he made this in 2025. It's striking, but it's true. Right now, 500 million Europeans are begging 300 million Americans for protection from 140 million Russians who've been unable to overcome 50 million Ukrainians in 3 years. So some sense that Europe needs to spend more on defence. Indeed, that's part of the reason why you've seen the euro rise recently. Some notion that spending more on defence is going to really catalyse reform in the European Union as well. And so for coming back for Australian relevance, what does that mean? I think the Australian government will be pressured to spend much more on defence. And so defence-aligned industries are going to be benefiting from that. I was in Darwin recently, and that was all the talk in Darwin. Also, a little unknown fact, just to give you where the government's priorities are or have been over the past couple of years. This year, we are set to spend more on the NDIS than we are on Australian defence. So I think there is some sense that reprioritisation of spending, a lift in defence expenditure, would be needed. Now, obviously, all we see is the headlines, but that kind of give you a bit of a guiding light for where the US administration is probably coming to. The second observation is the Trump administration has observed, or at least people in the administration have observed, that the US has run quite a large trade deficit with the rest of the world, and that's particularly with China, EU, Mexico, Vietnam, but also a whole heap of different other countries. Now, we could say that's a good thing or that's a bad thing, but at least in the administration's point of view, that has come at the cost of losing manufacturing jobs in the heartland of the US. Now, the key question for us, given that China is our largest trading partner, about 30% of our exports go to China, is what is the US seeking to do? And here we have to really get an appreciation. Is the US trying to totally decouple from China, or are they just trying to do a strategic decoupling, trying to get back certain industries into the US? The differences in those two arguments has profound implications for Australia. Unfortunately, it looks like the US is only doing a strategic decoupling from China, or at least aiming to do that. So Treasury Secretary Besant in 2025, the quote on the top there on the right-hand side, we do not want a generalised decoupling from China, but what we do want is a decoupling for strategic necessities, which we were unable to obtain during COVID, and we realised that efficient supply chains were not resilient supply chains. We're going to create our own steel, protect our steel industry, work on critical medicines and semiconductors. So I think that can kind of give you a bit of a guide for where the Trump administration is trying to get to. Strategic decoupling for certain industries, not a wholesale decoupling. The other aspect of the trade deficit is because of the US dollar's traditional reserve currency status, the US dollar had been overvalued for quite some time. I've got some PPP valuation models up there, but just worth noting the Australian dollar, for example, relative to the US dollar, 20% undervalued, or the US dollar is 20% overvalued. So there is some sense there that the US dollar has been overvalued, and perhaps some of these initiatives will lead to broad US dollar weakness, which is part of our FX view, but I'll come to that in a second. And the third observation is that the US administration still wants to have its cake and eat it too effectively. So they still want to run a relatively large budget deficit. And at the moment, the US budget deficit is about 6.5% of GDP, and it's likely to remain relatively high. Now, for businesses out there who are borrowing, particularly, say, between the 3 to 10 year part of the curve, that's going to be impactful because that's going to keep nominal rates high for longer. As people start to question, well, if the US budget deficit is going to remain very, very large, we probably need an extra premium there or extra certainty there in terms of servicing. So I think relatively elevated longer-term yields is likely to play out for some time.
Could you just, and in talking about Trump, I know you're going to talk a little bit again here about Trump, but there was obviously market shock to the headlines on Liberation Day. Since then, things have been watered down a little bit. Do you feel that the market is perhaps going to be, and Shane and I were discussing this before, is the market going to be a little bit less shocked by future headlines, or do you think he's still a walking headline that can impact markets the same way he did on Liberation Day?
I think there's a natural decay as people start to get used to the operating rhythm of shock and awe and then coming back to a more settled position. It had been a while, obviously, because Trump was in his first term, and then obviously we had Biden, and now we're getting more used to Trump again. So I think probably a little bit more of a decay there. And I think if you go back to those, I think markets are becoming a bit more familiar with what the administration is trying to achieve.
Mm-hmm.
And so I think you probably do get a bit more decay in terms of those really alarmist headlines. But if you look at the campaign rhetoric, what Trump was saying during his campaign, he wanted to put a 10 to 20% across the board tariff. And he wanted a high tariff on China. I think he went as high as 60%.
Mm-hmm.
It looks like he's going to get somewhere close to the lower bound of those things. So a 10% across the board tariff looks like it's going to be in place. Certain protections for certain industries in the US and a higher tariff in China. If you liken a 10% tariff in the US to effectively a 10% GST, because effectively this money is being redistributed because the US is government, because the US is running a relatively large budget deficit. So from that point of view, the economic impact is probably not huge. Probably makes you less productive as a country, and so there's going to be longer term considerations there. But in terms of the actual kind of growth implications, there may not be as large growth implications as people are fearing out there. And then in terms of the impact on markets, I mentioned the US dollar, and indeed what we have seen is the US dollar fall by about 5% over this period. The Australian dollar did fall all the way down to near 60 US cents at one stage during the peak of Liberation Day uncertainty, but has rallied back and currently only about 1% lower since when Trump was elected. The stock market is up about 5% since when Trump was elected. And what I find interesting is alternatives to the US dollar, hedges against uncertainty, hedges against inflation increased. So you look at the gold price, that's up by about 24%. You look at Bitcoin, and I'm sure some of you on this webinar hold Bitcoin, that's up by 53% since when Trump was elected. But going back to our earlier point in terms of that very large budget deficit in the US sustaining higher nominal longer term yields, the chart on the right hand side is just a decomposition of the US yield, the 10-year yield. The nominal yield is currently sitting around 4.4%. But what we have seen is the term premium actually starting to rise in the US as investors, I think, are starting to become a little bit more uncertain about the debt sustainability of the US going forward. Now, the trajectory for the US dollar is obviously very, very important in terms of the trajectory for the Australian dollar. And going to a lot of conferences recently, a lot of talk about diversification out of US dollar denominated assets. Now, we're not talking about wholesale selling of US dollar assets, we're talking about changes in the flow direction. So whereas previously you may have been 70 to 80% US dollar assets, you may be reducing that flow by a couple of percentage points. And I think there's a few themes going on here. And this is also reflected in the rise in the gold price. When you look at central banks, they're relatively worried about the potential for their FX reserves to be confiscated if there were to be a conflict. And indeed, when Russia invaded Ukraine, and putting aside the tragedy that was involved there, what the G7 and Australia did was confiscate the central bank's FX reserves. And they were able to do that because they were held in treasuries on a clearinghouse in Belgium. And so what that has motivated is some central banks are starting to pivot towards harder assets to keep their nation's reserves in. So you've seen the gold share of reserve assets rise, currently holding about 23%. The US dollar share of reserve assets has fallen down to 41%, and the euro share of reserve assets has been relatively flat, about 14%. There's a lot of talk amongst European officials, particularly the ECB, about reforms in Europe and how Europe could be an alternative to US dollar assets, and so that's something worth looking for. But it adds to this view that of a weaker or a structural weaker US dollar view. And indeed, on our central forecast for the Australian dollar around 65 US cents now, we expect it to get to about 70 US cents by the end of the year. Now, there's going to be a very big range there, as James was saying. Although there's a bit of a decay with the headlines emanating from Donald Trump, it could be that you do get some pretty big headlines that see a little bit of volatility in terms of FX. But I think the secular view is that US dollar is in for decline. At the same time, though, is if Europe is getting its act together, the cross rates, so Aussie euro, Aussie sterling, those types of rates are probably not moving dramatically in this environment. We think a lot of the moves is really going to come through a secular US dollar depreciation rather than necessarily an Australian dollar appreciation. And indeed, when you look at our models that we run on the Australian dollar, the model on the right-hand side there, which is really running off a measure of emerging market risk, that's suggestive that the Australian dollar should be higher right now. So that's giving you a 67 US cent, 67 cent mark for the Australian dollar. At the moment, it's obviously trading around 65 US cents. But as a word of caution, and just highlighting some of those downside risks that could emanate should those headlines start to emerge, an alternative model of the Australian dollar is consistent with the Australian dollar being well closer to 62 US cents. I think there's still a lot of uncertainty there, but our view is the US dollar is in for a structural decline, and that should see the Aussie-US rise.
I was going to ask on that one. I was just having a look at some of the feedback from our customers, and one particular quote here, they were really concerned about what's happening overseas, as you talked about tariffs, defence spending, on the foreign exchange rate, and I imagine a number of our customers have an exposure to the Australian dollar, US dollar exchange rate. What could our business customers, what should they be looking at as some sort of forward indicators of where that might move?
Yeah, it's a really, really good question. And I think it's those notions or those headlines of diversifying away from US dollar assets, because that's really going to be driving your US dollar weakness story. And in that environment, the Aussie US would continue to rise in that environment. So that's probably the biggest driver and the biggest headline that I'd be looking at for. And then, of course, we're due to get some certainty or at least some agreements on trade. If you don't get those agreements on trade and things start to escalate again, then that's where the downside risks start to emerge. So I think there's still a little bit of risk there, but at least in the secular US dollar decline story, we do see the Australian dollar lifting. The other interesting aspect is talking to some of your clients, particularly from the international side, is a lot of uncertainty in terms of imports, and particularly in terms of capital imports, given where tariffs are. And it looks like the cost of capital imports are coming under a little bit of pressure, but the cost of goods imports for consumers are not coming under that much pressure, because as China's trying to find new markets for its exports, it's diversifying, and some of that is finding its way to Australia at some discount. And so for people in construction, you're seeing falling steel prices, falling plumbing product prices, but the domestically produced materials such as bricks, sand, cement, that's still running at relatively robust rates of growth. And of course, wages growth is as well. So some of that diversification away from China should help alleviate some of the cost pressures, but the domestically produced cost pressures are likely to remain for some time. I appreciate I've covered a lot of detail in today's presentation, but really just to distill our view in three main points. So the first one is we think there's going to be a few more cash rate cuts to come. We think they will cut in July. We think the RBA cash rate will get down to about 3.1% by November. The market at the moment is pricing a little bit lower than that, and looking at model estimates neutral, it seems like the RBA board thinks neutral is probably more around 3.5%. Their suite of models has an average of about 2.7%, but again, with an unemployment rate of 4.1%, it's hard to see rates being moved too much lower than those kind of estimates in this environment, in the absence of a bigger offshore shock or in the absence of a bigger domestic slowdown. On our spending data, we have noticed a bit of softness coming from the consumer, particularly for those people under 25, and particularly for those people in the 45 to 54 years age bracket. But the household balance sheets themselves are in still relatively good shape. So as people become a little bit more confident in the outlook, a little bit more confident on the inflation trajectory, and as those RBA interest rate cuts come through, I think there's still a good reason to think there's going to be a pickup in the economy as we go forward. And thirdly, a lot of uncertainty in terms of international headlines. A lot of people focus on the method, and some would say madness. But if you distill it down to the three key observations that the Trump administration is trying to do, I think there are some benefits for Australian businesses. So whether it's spending more on defence, whether it's a realignment of supply chains, I think all those kind of things could be potentially beneficial for any business out there.
I think it's a really good point to pause as we go to some questions, but just to pause on the screen there, Tapis's division produces a lot of research, a lot of which is really valuable, but I am the world's biggest fan of the NAB Morning Call podcast. It's the easiest way to distill information. I listen to it on the bus on the way to work in the morning, 10, 15 minutes, tells you what's going on in markets. It's entertaining. It's a good way to pick up what's going on, even if it's only a couple of times a week. I can't recommend it strongly enough. There's a couple of questions which will be good to get to. The first one was from Renee asking, what is NAB's outlook on productivity for Australia in the next 2 years? It's probably going to be for both of you. We should hear from you first, Tapis.
Yeah, good question. We think there's a good chance productivity does pick up. And actually, when you look at the productivity numbers, and I don't have it in this set of slides, But productivity in the market sector, so excluding government-related entities, and also if you exclude mining, is growing at relatively okay rates of growth. In fact, not that dissimilar to what you're seeing in the US numbers. But what's hampering productivity in Australia is really the government sector and also construction and mining. So mining productivity, you can understand, you've got depleting reserve grades. That's quite understandable. Construction productivity is quite troublesome. When you look at the level of productivity in construction, I think we're about 10% less productive in construction than we were in 1994. So actual levels of productivity have fallen in construction. I think that's where one area is going to be a lot of focus there. And that's probably where some of the crowding out that's going on with the high share of the government in the economy. So government spending is the highest it's been since the 1980s. A lot of needed infrastructure work is going on right across Australia. But that's also crowding out resources for a lot of construction firms who are really focused on, say, the resi market or the commercial market there. So that's proving to be a challenge. And then,
sorry, go on.
Sorry, and then in terms of as economists, we like to think of these things called the productivity frontier. So look at the most productive country and how far away are we from the frontier of that. It turns out we're actually close to the frontier in many industries, particularly retail. And if you go to a restaurant in say Sydney, you'll see the QR codes, all those kind of things. You do the same thing. You go to the US, similar. So I think we're at the frontier in certain industries, but where we're not at the frontier is certainly in the government-related industries and also especially in construction and also mining as well.
What about you, Shane? What are you seeing for the productivity outlook?
On the mining ad, it certainly came up. It comes up a lot in conversation. I guess that comes from some of the margin pressures that we see when business talk about being more efficient, looking at ways that we can operate in a more efficient way. And I think a lot of what you talk about plays into that. There's government regulation in there as well to support that. But I think what the common trend is in the AI is what the only thing I would add. I think it's more inquiry about what does that actually mean for me in business in a small or medium or large business enterprise. And we're seeing the investment. I think it was Amazon last week, Tavis. It was 20 billion being invested into data centers into Australia. So you see these major companies very confident that there's a delivery that we can put into business that helps productivity. And I think for us and for business owners on this call, it's about trying to understand how do we access that. I think there's an opportunity that maybe from a NAB perspective, we can help our customers with that in another insight series.
Very good. Tapas, there is one question here, which we'll squeeze this one in, and a couple we'll have to leave out, but a good one about an overall structural breakdown in USD a reasonable indicator of widespread upward pressure on assets priced in USD and then vice versa, i.e. a climb in USD strength would be a forward indicator on bearish conditions?
If I've understood the question right, if you were to see a lift in the US dollar, then is that reflective of bearish conditions occurring? And potentially, yes. So if you were to get a risk-off environment, and indeed in the very initial missile salvos from Israel to Iran, you did see the US dollar rise in that environment. So yes, that could be reflective of that kind of situation. So it could be in a big risk-off environment, when the US dollar is still favoured. But I think from a longer-term perspective, and here we're talking 0 to say 5-year perspective, I think there are very good reasons for a structural US dollar decline. As you have a little bit of loss of US exceptionalism there, you finally have governments around the world spending after being very conservative with spending for quite some time. And the main driver of that is the pressure that US administration is putting on other countries to spend on their fair share of defence as they focus on other areas of the globe.
Just lastly, Shane, in your travels, you've spoken a little bit about business conditions and how customers are feeling, and you've spoken to a lot of bankers. Is there anything else that you'd like to share from those travels in the last month or so?
Thank you for that. I think something like this does really help. There's a lot of uncertainty, and particularly businesses that have exposure to imports of foreign currency movements. We're thinking about interest rates. We're thinking about business confidence, and it's an opportunity for me to support your message on the morning call podcast. Information is there. There's a lot of information that we can provide that can help business owners just trying to understand what's happening in the environment and really help with some of the decision making that you need to make. So I just thought it was really good, really distilling a lot of that information that we read about overseas into 3 core points. I'd love to, maybe, James, we should share that with as part of post this. So there's a lot of help there is what I would say.
Yeah, so that's really good. And what we will do is after this webinar, there'll be a link to the recording sent out, the slides, some other information. Some people asked about the survey, so we'll probably send some links to the business survey. Kat Chamberlain, who's our events coordinator, will be sending out that information to you as soon as we get it compiled. And if you are concerned at all about the interest rate market, the FX market, or the commodities, how commodities impact your business and your bottom line, please reach out through your banker, reach out through me directly or Shane, and your market specialist. We're happy to have a conversation. That's the role we play. We've got people out in the field keen to have a conversation with you about those. And also at the end, just one last thing is that the survey will pop up at the end of this. We're having a monthly insight series now. It won't always be economics and this sort of presentation, but we are having a monthly insight series. If you could please click in there, things that might interest you. Shane talked about AI. It's a very hot topic at the moment. So if you could put in what interests you there, we'd love to be presenting what's on your mind. Otherwise, we'll leave it there. Thank you much for joining us.